a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about safe haven ETFs. So this year has been very challenging for investors because both stocks and bonds have fallen at a pace which was not seen in decades. The S&P 500 is down 23% year to date. Nasdaq has plunged 31%, and the long-term government bond ETF is also down 24%. Its worst performance ever. So historically, safe haven assets like gold, US dollar, Japanese yen, and Treasury bonds provide some protection to investors during periods of immense market turmoil. But this year is just different because because inflation has accelerated to a new 30-year high. So Federal Reserve is expected to raise interest rates aggressively in the coming months to tame these surging prices, and it remains to be seen whether the central bank will be able to engineer a soft landing. So these rising rates in the US have boosted the dollar, which is now at a new two-decade high and up about 10% year to date against a basket of other major currencies. The yen, the Japanese yen, on the other hand, has taken a beating. So this is Japanese yen is trading at a 24-year low against the US dollar because the Japanese central bank, the Bank of Japan, is expected to continue its ultra-easy monetary policy, which would keep the yen weak. Now, as far as the dollar surge is concerned, mainly because of higher rates, rising rates in the US, it remains to be seen whether this surge can continue at this pace, because now other major central banks have also started tightening. Switzerland central bank, they raised their interest rates for the first time in 15 years last week. And the European Central Bank, ECB, is also preparing to raise rates. They will start raising starting July. Now, if you want to invest in the dollar, there are two ETFs. So the first ETF that I'm highlighting is by Invesco. The ticker symbol is UUP. It tracks the performance of dollars versus 6 major world currencies, quite popular with some 1.7 billion in assets and has an expense ratio of 78 basis points. The other one is by Wisdom Tree, ticker symbol USDU. This one is actively managed, smaller with 370 million in assets, and also slightly cheaper with 50 basis points expense ratio. Now, if you want to learn more about these ETFs, you can go to the quote page on Zacks.com. And using the link, you can go to Invesco web page for the ETF. So UUP tracks the performance of dollar versus the euro, Japanese yen, British pound, Canadian dollar, Swiss krona, and Swiss franc. In its basket, it holds these currencies. USDU, the one by Wisdom Tree, that also provides exposure to the US dollar against a basket of foreign currencies because this is actively managed. So this basket can keep changing. It can also have emerging market currencies in the portfolio. Now, let's take a look at gold. So gold is traditionally seen as a safe haven and also as a hedge against inflation. And gold hasn't really taken off like the dollar, but it is still up 2% year to date, which is very impressive compared to the performance of stocks and bonds this year. So gold also did provide some protection to investors. Now, the problem with gold, why it has not taken off, is that gold usually moves inversely to the US dollar. So because US dollar surged, gold prices did not really take off. But if US dollar surge stalls at these current levels, then we may see a rally in gold. So that remains to be seen. But one more thing I wanted to mention, that higher interest rates dim the appeal of gold because gold does not produce any income. So the holding cost of gold rises with rising rates. And another point which investors should keep in mind is that last year gold did not really do very well, did not take off, because many younger investors, millennial investors, were putting money in cryptocurrencies, particularly Bitcoin, which they saw as a digital gold. But now, since cryptocurrencies have plunged, and they see that Bitcoin hasn't really performed the role of a digital gold or as a safe haven, so many are coming back to gold. Now, physically backed gold ETFs are the best way of investing in gold through ETFs. The most popular gold ETF is GLD, oldest and largest, 62 billion in assets, has an expense ratio of 40 basis points. Then a couple of years back, the State Street launched a cheaper and smaller version of, by smaller I mean the smaller price handle version of GLD. This is called GLDM. This has also become quite popular despite this is very new. For 5.2 billion in assets and charges just 10 basis points in expense ratio. In fact, they recently reduced the expense ratio further to make it just 10 basis points. So if you are a short-term investors, you want to trade in gold, then GLD is suitable for you because of its excellent liquidity. But if you want to hold gold for slightly longer term, then GLDM is the ETF for you. Now, again, you can go to the quote page on Zacks.com, and using the link, you can go to State Street webpage. You can also read our research report and articles on gold. But there's not much to see in gold. Both GLD and GLDM will track the price of gold very, very closely, and you will get the same performance with both the ETFs. Now, then Treasury bonds are seen as safe haven assets. Traditionally, when stocks go down, bonds go up and provide protection to investors. But since bonds move inversely to interest rates, this year they have failed in that role. So Treasury bonds have delivered their worst performance ever this year. And investors should remember that higher duration bonds have more sensitivity to interest rates. So they could look at shorter duration Treasury bond ETFs like SHV, which has 20 billion in assets and has an expense ratio of 15 basis points. But if you believe that rates have gone up too much too soon, then probably you could look at slightly higher duration, 7 to 10 years Treasury bond ETF, ticker symbol IEF. This also very popular, 17.4 billion in assets, expense ratio 15 basis points. There's another one which provides comprehensive exposure to the entire Treasury space. But again, if rates go up from here, this will underperform. So only if you believe that rates have gone up too much too soon and it is time to get back into Treasury bond ETFs, then probably you could look at government ETF, GOVT ETF. This is very, very cheap with just 5 basis points in expense ratio. Now, to learn more about these ETFs, you can look here. So this is the short Treasury bond ETF. So this would provide a cash-like exposure. So this is almost flat for the year. It holds Treasury bonds that mature in less than 1 year. Now, the second one, which I had mentioned, is 7 to 10 years. So this is down about 12.5 year to date. The third one, which I had mentioned, GOVT, this provides comprehensive exposure, 1 to 30 year maturity with an expense ratio of just 5 basis points, very, very cheap. And year to date, this is down about 10%. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, and I'll see you next week.